Present.
Thank you, Pam. The first item on the agenda is public comments. Are there any members of the public present that wish to speak?
Sorry, just one quick one. Since you guys are always giving us the information about what has happened, which is what the report does, I was wondering if you could also address a little bit on where you think the markets will be going and how you're positioned over the next 6-12 months or so. Thank you.
Thank you for your comments. Next item on the agenda is for the approval of the consent agenda. First is the approval of minutes from last quarterly meeting held on November 21st, 2024. Second is the approval of expenses. At this time, we have received 2 invoices from Burgess Chambers, 1 invoice from Foster & Foster, 1 invoice from Sterling Capital, and 2 invoices from Truist. Lastly, we have the approval of 1 retiree. Do I have a motion and second to approve the consent agenda?
I'll make a motion to approve the consent agenda.
I'll second it.
All those in favor say aye.
Aye.
Moving on to new business, today we have Blake Mighton presenting quarterly reports for Sterling Capital. Mr. Mighton.
All right, good afternoon. I will definitely look into my crystal ball and try to give you our best guess on what we think the market's going to do in 2025, as well as obviously review the fourth quarter and the start of our fiscal year. Although you'll see, again, kind of a lot happened, but we kind of were pretty flat for the quarter. Not to give away the ending, but before we kind of go into that in a little bit more detail, just for the edification of the new finance director and chair. Again, my name is Blake Mighton. I work with Sterling Capital. I've had the pleasure of working with you guys for, I guess, a little more than a decade now, going back to the old SunTrust days, and then SunTrust turned into Truist, and then Truist sort of had a investment management subsidiary of the old BB&T called Sterling Capital. So I slid over there as part of that transition. And then Truist actually sold us in the middle of last year. So we're now completely separate from Truist, although Truist still remains the custodian. We still work with them. But we really manage the U.S. Equity portion of the plan along with the fixed income assets. That's sort of our mandate is spelled out in the investment policy. And then there's obviously other assets that are outside the Sterling sort of control, and those are held in a custody account, and Larry kind of helps the board direct those assets in various asset classes that kind of started as we didn't really have exposure to those in the old SunTrust platform, and kind of it developed from there into some other asset classes. So very well diversified, as you'll see here in a moment. But that's kind of the gist of it. So I will at least keep my comments sort of confined to the U.S. equities and fixed income markets, and let Larry opine on those other asset classes where he has much more knowledge. Sound good as a background? All right, well then let's dig into this quarter. And like I said, it was kind of a lot going on, but the markets really kind of ended up pretty flat. If we dive in over behind tab 2 is the asset allocation sort of summary page, or what I call the scorecard, if you will. We've got all the major equity and bond indices on this table. The stocks are up top and the bonds are down at the bottom. So first row there is the Russell 3000 growth, or the broader U.S. benchmark. Good solid quarter, up 2.6, and for the year to date, up almost 24% or 23.8. So very, very strong performance. So that's 2 years in a row that we've had over 20% returns out of the U.S. equity market. So good, solid performance in an absolute sense. Diving into it, though, as some of the other trustees that have been here for a while know, we talked a lot about those AI-related Magnificent Seven stocks that really drove the market in the first half of 2024. We saw a bit of a broadening, and to include some of the other names during the third quarter. But then this fourth quarter really kind of went right back to those same names, and it even shrunk a little bit. So we called them the Fantastic Five, because Tesla and Apple didn't quite keep up as much as the other 5 names. But those really, again, really led the market higher. And we can kind of best see that if we look at the third and fourth rows there, the Russell Top 200 Value and Top 200 Growth. For the quarter, those top 200 value names were actually off a little more than 2%, or 2.11, and up about 15% for the year. And while the growth counterpart was actually up closer to 7% just for the last 90 days or the final quarter, leaving it up a little more than 35% for the year. So nobody's going to complain, at least shouldn't complain too much about a 15% return out of those value names. But when growth was up closer to 35, that's a really big difference for just one single year. So a little bit unusual. As we look into our crystal ball, we see a broadening out of that. We've kind of remarked that just those 7 names, kind of were the bulk of the return for the S&P 500 or even the Russell 3000 or any kind of U.S. benchmark that you look at. We look for those other names to start being recognized because candidly, those aren't the only names that are going to benefit from AI, right? At least in theory, we all should benefit in one shape, form, or another. And we started to see some of that, like I said, in the third quarter, but then we kind of reversed it. The other thing that was really paramount during the quarter was the bond market. It really became very apparent, I guess, at the beginning. We started off really well in October and early November as it became apparent that Mr. Trump and maybe the Republicans were going to win all 3 phases of the House, the Senate, and the Capitol Hill, or and the presidency. So again, the market being what the market is, the one thing that the market does like is when all 3 powers align in one party or the other, because it just makes predictability a little bit stronger, a little bit higher. We can kind of figure out what their agenda is and trade off of that. The big one is drill baby drill. So energy should do a little bit better. That's one of the areas that we're looking at and our managers are adding to and think should do a little bit better this year. But we look for really those non-U.S. tech names to kind of start to perform a little bit better in relation. And so again, that's kind of what we see the market now. From an overall perspective, we don't see a recession in near term. We don't see a gloom or doom kind of scenario as we kind of look out into the future. A lot of the variables we look at remain pretty positive. The economy is still pretty strong. Earnings came in very, very solid this first quarter. Guidance forward wasn't too terribly bad, and that's kind of why we've seen the market up 3 or 4% year to date so far. So that's certainly a positive. The other positive is the U.S. consumer, which makes up about 2/3 of the economy. We're still very flush with cash. We still feel really good about it. We are starting to see a little bit of a bifurcation with the high net worth versus those lower income names. Kind of saw that in the Walmart number today, and their guidance going forward was very cautious, and that's why the market was off today, was Walmart sort of had their earnings call and were a little disappointed with some of the forecasts that they provided for the rest of the year. But again, overall, though, the consumer is still in pretty good shape. Companies are still making money. So from that perspective, we still think high single digits is a pretty realistic equity expectation for this year, even with the 20+ returns we've gotten in 23 and 24. I'd love to sit up here and tell you we're going to get another 25%, but that's really unrealistic, and I don't think it's ever happened 3 times in a row. So the odds are stacked against us, even with the good backdrop. So again, that's kind of what we think on the equity side, is we do see a little broadening. On the fixed income side, that was really kind of the story of the fourth quarter, because we had some solid equity returns, but you'll actually see some pretty terrible, on an absolute basis, bond returns. The Bloomberg U.S. Aggregate, which is the broad benchmark for fixed income or the bond portfolio, was off over 3%. I mean, and we don't typically, we usually get 4 or 5% out of a bond portfolio. That's supposed to be the stable sort of, the hare and the rabbit. That's the hare part of the portfolio. It's supposed to be slow and steady and good, solid income. What we really saw was after the elections, the mood after the equity markets sort of rallied and applauded the election results, bond investors did just the opposite, thinking that maybe all of the rhetoric and all the talk about tariffs on the campaign trail were going to lead to inflation, which was going to lead the Fed to not lower rates as much as they had previously expected. So what we saw was they voted with their supply and demand dollars. Because what was really unusual is the Fed actually lowered rates during the quarter a couple of times, but we still saw pretty negative returns out of bonds because of those bond investors selling their shares and readjusting their interest rate expectations for this year. As we stand here today, there's one, I think the market now has only one interest rate decrease, 125 basis point decrease in the futures expectations for the rates later this year. And we're probably in that camp where we'll probably get somewhere between none or two, one or two at the most, depending on what kind of data we get between now and then. Obviously, it's predicated on the economy continuing to improve, earnings continuing to grow, and no unforeseen events. But at least as we look into our crystal ball this year, that's kind of the way we're positioning portfolios. So what you'll see is, last year we kind of came into the year a little overweight our targets in stocks. We readjusted to be a little bit underweight our targets mid-year. And then as we sit here today, at the beginning of January, we rebalance back to more of a neutral stance, at least for now, which kind of means that we recognize that stocks have run very nicely over the last couple of years, probably improbable to get another 20-plus return, but we still like stocks. And then on the bond side, because of some of the sell-off we saw this year, we're a little bit more constructive about that piece of the portfolio. Again, now that that 10-year rate is hovering around 4.5%, we think it should stay there, especially if the Fed doesn't have to lower the shorter end of the curve much. So from that perspective, that's kind of a 4 or 5% return out of that piece of the portfolio we would call very, very good 2025. So that's kind of, as we look into our crystal ball, our best guess. That's always subject to change, but so again, just kind of I touched about the quarterly return, but it kind of wiped out what was otherwise a pretty solid year for bonds. If we look at the 1-year number for that aggregate, it dropped it down to just 1.25. We were tracking in that 4 or 5% range, which is kind of what we think is going to happen this year now that we've seen the adjustments. So with that, guys, there's a whole lot more in this first section that dissects all the sectors on the next page. Suffice it to say, it was kind of a repeat of what we've seen the last 2 or 3 years. It was really those U.S. AI-related tech names were the best performers. So growth did a little bit better than value. And then the larger companies did a little bit better than medium and smaller size companies. And lastly, the U.S. really kind of dominated as they did significantly better than international last year. So that's kind of a quick and dirty on how the equity markets went. And then bonds traded off a little bit, had a subpar year, but again, we look for things to normalize and stabilize this year. The rest of this section dissects every little nook and cranny of every part of the market to kind of come up with our best thinking. Don't usually go into a lot of detail there unless you guys have any specific questions. But before I switch over and talk about our portion of the plan performance in a little more detail, let me just stop talking and see if there's any questions, comments, thoughts. No? All right, seeing none, then let's talk over on page 22 behind tab 3. Let's talk about our piece of the portfolio in a little more detail. This first page is the portfolio summary that shows the cash flows for the various time periods. We got the month, the quarter, and the fiscal year, which happened to be the same this quarter, and then obviously the 1 year. And then the inception date when we switched over from the old Truist performance team over to the management at Sterling. So you'll see that was almost 3 years ago now, or I guess 2 3/4 years. But for the fiscal year, we started off just under 21 million there at 20,927,000. We had the annual city contribution came in this quarter, so that's the net contribution of a little more than 560,000. We had income primarily from the bond portfolio for dividends and interest. It was about 290,000. We had a slight small capital depreciation of about 300,000. Net out some fees, and the portfolio stood at just under 20. Our piece just under 21.5 million, or 21,450,000. And to put some percentages to those dollars over on the next page is the performance of our piece of the portfolio. We've got the graphical representation there at the top, and then in the middle of the table is the one I'll concentrate on. And you guys are the dark blue with our benchmark, our blended benchmark of U.S. stocks as measured by the Russell 3000, and fixed income 5248 there in the lighter blue section. So we were almost flat, off 0.01% or 1 basis point, while the blended benchmark was essentially flat too. It was off about 10 basis points. So really performed in line with that. Moving down, you'll see that it really was the fixed income piece that did slightly better, even though, again, it was a negative for the quarter. When the market, the benchmark was off a little more than 3%, we were off about 2.7 or 2.68. So that's really what caused us to be slightly ahead of that blended benchmark, was the bonds held up a little bit better. We were just a little bit more conservative with that piece of the portfolio. We had a couple of out of benchmark holdings and shorter term treasuries that were a little bit more conservative, as well as some inflation protected securities that were also shorter in maturity. That kind of helped us a little bit when the market sold off. So those were the primary reasons that piece outperformed, and we outperformed ever so slightly. Still was a challenging year though. As you see, the 1 year, nobody's going to complain with a 10, almost 11% return. But when the blended benchmark was closer to 12.5, it's really kind of indicative of those AI-related names. We had them, we just didn't have nearly as much as we needed to. And that's kind of been a real challenge for a lot of active managers. And we've talked about this in previous meetings. We like NVIDIA, we like Microsoft, we like a lot of those AI-related names. We just didn't have 12 or 15% of them, which is what you would have needed to have in some of those names to kind of outperform. You'll see here in a minute, our large cap growth manager did exceptionally well. He just couldn't outperform that 35% return while he owned a lot of those names. He owned 6 out of the 7. He just didn't own them in the magnitude of the weights that you needed to outperform. That combined with, I'll talk about some of the individual pieces and what worked and what didn't, but we're still very, very happy with that almost 11% return. And again, for the edification of the new finance director, we're never going to manage this portfolio to try to get 15% when the market's up 12. We're just not comfortable taking that kind of risk. We're much more comfortable coming back, showing you an 11% return when the market was up 12, and protecting those assets when things do roll over, whether it be COVID back in 2020, financial crisis in 08. What we don't want to do is come out and show you a negative 12% return when the market was down 10. Right, so again, each and every one of these managers we scrutinize and look at, and their risk return characteristics are very consistent with that. But we'd love to get 95, 98, 100% of the upside when things are good, and for that we'll give up, only get like 85 or 90% of the downside. That's in our eyes how we're trying to manage these portfolios, and what we're trying to do is kind of protect us a little more on those down years. So over on the next slide is the asset allocation. Again, not even including the outside pieces, very well diversified here. Each and every one of those little blue pieces is a separate segment of the equity markets, and then we've got the very well diversified core fixed income portfolio with treasuries, mortgages, corporate securities, et cetera. But as you can see, kind of a proof statement is what I talked about earlier, very close to that target benchmark. We ended the quarter at about 53% in stocks, and 46% in bonds, with a little bit in cash, when our target's more of a 52-48, so really right on top of it. And then I'm going to finish up talking about just a couple of pieces of the portfolio that we're watching a little closely, as well as some of the funds that performed very well. The first we're watching pretty closely is one of our own. It's this, the first one there, that first grouping under large cap value. It was off about 5% for the quarter, when its benchmark was off closer to 2%. The primary reasons for that is this particular strategy really puts an emphasis on dividends and higher quality companies, and that's really not what the market was rewarding. Not only was growth the primary driver, it was the lower quality, riskier stuff in the universe that tended to do a little bit better last year. No problems, no issues here in our mind. This fund has outperformed, or this process has outperformed 6 or 7 straight years. 2024, we think, was just an anomaly, and hopefully when the market starts to broaden out, they should do a little bit better as well. So that's one but we'll continue to watch that and monitor it, and if we need to make any changes there, we certainly will. The other two, mid-value and mid-growth, didn't perform quite as well as we had hoped. It did a little bit better this last quarter, but they really kind of struggled the first half of the year. We used some Touchstone Capital Management as the manager for both of these pieces. And again, their 1-year numbers aren't particularly exciting, and even their 2.5-year numbers are a little bit below average. But again, longer term, 3, 5, 7, 10 years, their longer term averages have been much better. So we're going to continue to watch those as well. And then I alluded to the one that really drove good solid performance was large growth. We'll use a Loomis sales product in that particular category. That's that third grouping there. As you can see, we've got about 2.6 or a little more than 12% of the plan there, of our piece of the plan. It was up over 9% for the quarter, again, when the benchmark was up closer to 7. And then for the 1 year, up 34.6. Couldn't quite keep up with that benchmark at 35.1, but still good, solid performance on an absolute basis. And then obviously for the almost 3 years that we've had him, they've done a very good job in that particular space of keeping up. And I touched a little bit on the bond portfolio down toward the bottom. Those categories, really the core category outperformed, and again, having a little exposure to those shorter term treasuries helped as well. So that was really the primary reasons for the slight outperformance there. So really, that's what I wanted to cover today. The next page goes into the same kind of detail, but looks at each and every fund in those various categories. And then I usually finish up over in the appendix on page 29. One of the things that we recognized when we transitioned from SunTrust to Truist over to Sterling was, what the board really cares about is not what Sterling's performance was for two and a half years. How did we do longer term? So what we did was link our performance with that historical performance to give you all an idea of how we've done versus the benchmarks over longer periods of time. And as you can see, again, the 1 year slightly behind the benchmark, that sort of dragged down that 3 year a little bit, but longer term, 5, 7, 10, and going all the way back to the inception number isn't quite. It's a little bit wonky here because we had so many changes way back in the 90s and early 2000s before. So we probably should just drop that number, but again, our piece of the portfolio over the 5, 7, 10 years has performed in line. And, so with that, guys, again, pretty optimistic, but also a little weary about 2025. The one thing I've been telling clients with 100% certainty that I can guarantee is going to happen this year is volatility. We saw it under Trump 1.0, and the markets reacted a little bit more up and down to tweets and various communications coming out of the Oval Office on a pretty regular basis. So politics aside, we think the markets will probably continue to be a little bit more volatile with those kind of things. We're going to continue to watch tariffs. We think that's obviously going to be a big impact on 2025. Right now, we're not overly concerned. I didn't really talk about this previously, but just to give you our 2 cents or our thoughts on the tariffs kind of fall into a couple of buckets. One is the negotiating bucket, and that's kind of probably what we saw with the initial wave of our border tariffs at 25% on Mexico and Canada. That wasn't really about tariffs. That was more about trying to make sure immigration and some drug policies get reinforced and other parts of the agenda, not so much tariffs. The second wave, though, like the aluminum and the steel tariffs that were announced last week, those are probably just protectionism. I mean, and again, that goes on all around the world. Candidly, we're one of the few countries that don't do it. So I think that's just protecting U.S. interests in various industries. And then lastly, again, we'll continue to monitor that, but obviously China was the big one. And again, I think the way China handled it, the way the president handled it was just sort of very, very kid gloves, if you will. He talked about 60, 70% on the campaign trail tariffs on China. He came out with a 10% tariff. And again, their response was pretty muted as well. They basically taxed very large vehicles. I don't know if you know, but there's not a whole lot of F-150s running around in Shanghai. They're not usual, so that tariff's not going to have a big impact on U.S. So their response, I think, was more important. That, hey, listen, they're willing to negotiate, and there's going to be more to come. But so again, we'll continue to monitor that. We think that'll obviously make some headlines and lead to some volatility. But again, we're used to the volatility, and we're going to stay the course, and I think we'll be in pretty good shape this time next year. That's a long-winded way of saying we're pretty flat for the quarter, and we're optimistic, kind of, about 2025. Any questions, thoughts, comments?
Blake, I should have called you on this before, but I don't mean to blindside you, but you've got there's a pretty heavy tilt towards large cap growth in your growth allocation there. I mean, you've got, on paper, it doesn't look that way because you've got the Vanguard S&P 500 ETF at about 4 million, lower 4 million. And then you surrounded that core, you're treating that, I guess, as a core fund. And then you got Loomis large cap growth 2.6 and then Sterling, the value at 1.5. But that S&P 500, as you know, is very, very tilted towards the Mag 7, capitalization-wise. Is there any talk within your group, do you know whether they're talking about maybe balancing that out a little bit more from a style?
Well, Larry, it is, I think, a little bit deceiving because we're tasked with the Russell 3000 is our target.
Right.
And if you look at the growth value tilt there,
Right.
because of the run in those 7 names over the last few years, it used to be 55-45 growth versus value. It's a whole lot closer to 60-40, and that's really more indicative of how we're doing it. We actually have a slight growth underweight relative to the Russell 3000 when we combine the portfolios together, when we do the looking at it. But if you look at it, you say, oh, there's 2.6 in large growth, there's only 1.5, 1.6 in large value, and the core has more in growth and value. It would be easy to think that there's a growth overweight, but that's not the case right now. As a matter of fact, we're slightly under.
Well, there's not a growth overweight to that benchmark, but there is a growth overweight
To the benchmark, correct.
to the portfolio.
To the Russell 3000.
Yeah.
So by definition, yeah.
Right.
We can talk more about it, but at least the way it's constructed now, we're pretty comfortable. We've been tasked with beating that Russell 3000, and we've got the allocation that we think will do that best. But I recognize what you're saying, and you're saying is there's a, and again, I think it's probably underrepresented or not really talked about much, but you and I have talked about it. Is that there is like a lot of risk in the S&P 500 that a lot of people don't realize, right? I mean, those names have run so far so fast that some of the valuations are getting, towards extremes, especially in that large cap growth area. So we recognize it, and again, we try to mitigate it as best we can through diversification and balancing it. And like I said, we're actually slightly underweight growth in total compared to the Russell 3000, but we do realize those growth indexes are pretty risky at this point.
Just so everybody understands why that is, the benchmark, like the S&P 500, it's what they call capitalization weighted. It's not 500 stocks equally weighted in that benchmark. The S&P 500 benchmark is capitalization weighted, so the larger companies have a bigger impact. Well, it's never been more concentrated than it is now, and that was because of the run of the Mag 7 stocks. So when you see somebody saying they're holding the S&P 500, you might think, well, that's diversified.
500
nice
names.
diversified
Yeah.
500 names. But really, when you look at the characteristics itself of the S&P 500, and I know that's getting into the weeds a little bit, but the S&P 500 is a large cap growth stock right now, just based on its characteristics. I think it's selling at a price to earnings multiple of maybe 30.
Yeah, it's in that
or
30
something.
range,
It's very
which is
high.
very expensive.
And so we try to take that into account as we're looking at asset allocations, and that's why I asked the question what their committee is. But again, he's right, relative to the benchmark, they're not overweighted to it. So, if your goal is to keep up with the benchmark, you almost have to go there.
A little bit,
Yeah,
yeah.
yeah.
Which,
And it's by the way, it's helped you up until today.
until it doesn't. Yeah,
Yeah.
it always helps until it doesn't.
Until
But
today, they really, I don't know if there's any place to hide today, but yeah. Okay.
Where do the
Thanks.
benchmarks come from?
I think they sort of developed, candidly, over the last 30, 40 years on ways to grade investment guys like me. It's like, okay, you're up 4%, you're down 4%. I don't know, is that good? Is that bad? So what the various industries tried to do was, create some sort of benchmark or target that gives you some sort of sense of, okay, is that good? Is that bad? How did similar other investments do? So not only did we create, the industry sort of created targets and benchmarks, But there's also, what Larry does as the consultant is they have universes where everybody subscribes to, and they put their active manager numbers up against other active managers to give you a better sense of how your managers are doing, not just compared to some static benchmark, right? I want to know how you're doing compared to other guys that are doing what you're doing. So from that perspective, that's kind of the two layers of evaluation, and it really is just to give you guys a sense of, are we performing in line with expectations and goals, and are we doing it, similar to other managers and taking similar kinds of risk? All of those kind of go into Larry's report in a little more detail, but.
And just for your knowledge, if you're watching the news and you see there's really three major indices right now, or benchmarks, if you will. The S&P 500, the Dow Jones you see reported, and the NASDAQ. And the way you can look at that is, in theory, the S&P 500 is more core, but it has now a very, very growth tilt, with a lot of tech names in there, the Mag 7. The Dow Jones Industrial Average is kind of that. It's a little bit more industrial, a little bit broader. It's a little bit more economically sensitive, I would say, historically. It'll give you a little broader, there's only 30 stocks in it, but yet I think it gives you a little more diversification than the S&P right now.
I agree with that. Not quite as tech heavy for sure.
It's not quite as tech heavy. And then the NASDAQ, you can just assume if tech's doing well, the NASDAQ's doing well. The NASDAQ is very
vice
heavy
versa.
tech. So when you see those reports, that'll kind of give you an idea how you're doing. And then the bond market also has a bunch of indices too, which are, that you could pick from about 30. But
Yeah, but the aggregate's sort of everything
Yeah,
thrown
the
together. As the
Bloomberg
name sort of
aggregate.
indicates, it's got mortgages, treasuries, and corporate bonds, so it gives you a really good sort of look of all three of them combined.
And they're kind of the most widely used. I mean, there's variations off of all of those, but we don't usually get too far into those weeds, except when we're actually looking at individual managers or individual funds and want to evaluate how they're doing. So, thanks.
No, thank you.
Next, we have Mr. Larry Cole presenting quarterly reports for Bridges Chambers.
All right, well, good afternoon again, everyone. I'll get to the first, if you go to page 2 of our report, this is just looking at the markets for the quarter. You already kind of got a feel for it from Blake. This is not portfolio specific on page 2 and page 3. Those are just market indices, so to give you an idea what happened. As far as what we think is going to happen and looking out into 2025, I don't think we're too far off of what Blake's kind of forecast is. I would expect stocks probably, best guess right now, you're probably seeing 8 to 10% year out of most stocks. That may sound wild given what's going on today, but the reality is year to date, we're going into today, we were about halfway there. Most indices were up anywhere from 3 to 6%, depending on which benchmark. Smaller cap stocks were doing a little better, or mid cap, I guess, were doing a little better. And what we have seen this quarter so far looked a lot like the third quarter of 2024, in that we saw a broadening of the market. When I talk about that Mag 7 dominating the market, I mean, like I said, it's never been seen, the concentration has never been seen like this before, and it was very hard for most portfolios to keep up in that. In the third quarter of 2024, we saw the market broaden, and I've said in this meeting, I'm probably the last 2 or 3 times, if artificial intelligence is everything it's cracked up to be, the S&P 493, the non-Mag 7 stocks are going to benefit tremendously too, but the market didn't seem to care about that. Right now, they were just, up till now really, they've just been rewarding primarily the creators, the chip makers, those people for AI, but you'll see that trickle down to the other companies, I think, and we'll see a broadening. Well, so far, year to date, we've seen the market broaden again, and it's happening even though everything's getting hit today. Tech seems to be getting hit pretty hard. It was the Walmart forecast seemed to trigger it, and it wasn't their earnings were great, but the guidance they gave was a little bit cautious about their growth. But if you go back and look at Walmart, and I heard a good analyst as I was driving here today. I had to drive over actually from Sarasota today, so I got to listen to a lot of analysts today. But Walmart's always conservative in their guidance, always. So they always kind of set a lower bar, and they were up over 80%. That stock's been up over 80% in 2024. So there's probably some profit taking in there after they came out and said, hey, things might slow down a little bit. The tariff talk could impact them, although a very high percentage of their business now is food, and most of their food is sourced in the U.S. So it may not hit them as hard as you might think, because I think most of us think of Walmart, everything's made in China, and that's why they price it so low. But apparently that's changed. They've kind of changed the mix a little bit. So, but anyway, we don't know what those tariffs are going to be and where they're going to be anyway. So that's been in the news. I don't think that moved everything today. There was a big sell-off on AI tech stocks related to the defense industry. So anybody who had big contracts with the defense industry got hit today. The president has given the Department of Defense a mandate to cut expenses 8% a year for the next 5 years. So some of the names, particularly in the NASDAQ, that were related to AI and had big defense contracts got hit a little bit on that news today. So that combined with the fact that interest rates aren't going any lower for a while, I don't think we'll see a rate cut this year. That's just one person's opinion. The votes are all over the place. But I don't see the need for it right now, and I think it would be pretty inflationary if they did. And I think the tariffs are going to be inflationary enough to deal with in the short run. So I don't see a decline there. So anyway, that's kind of the forecast for 25. Bonds will probably, if you can get a coupon return, maybe get 4% out of your bond portfolio this year. That'd be good. And then hopefully we'll get somewhere between 8 and 10 on the stocks. That would be kind of where I'd guess we'd be. But there could be about 1 million, as much as coming out of Washington these days every day. There could be 1 million black swan events to interrupt that forecast. So we'll just kind of hang in there. When it gets this noisy, what we tend to do is even rely more on our long-term targets in the portfolio and kind of keep our eyes focused and stay steady as she goes. So anyway, page 2 is the equity markets. Page 3, that's the top, is the bond market. Again, Blake touched on that. We were actually down 3% for the quarter. Now, remember, in a bond portfolio, if you're already holding the bond and rates go up, the market value goes down. Well, interestingly enough, in the fourth quarter, the Fed cut rates in November, 25 basis points, and in December by 25 basis points. That was the short end of the curve. So the short end of the yield curve, short-term rates went down. The market said, I don't know why you're doing that, or, the market said a lot of things, but it didn't say we're going to lower rates. And so the market controls more of the intermediate and longer term rates, and intermediate and long-term rates actually went up for the quarter. And that's why you see a negative return for the bond portfolio. That has kind of flipped around a little bit. They haven't moved too much. The bond market's pretty flat for the quarter, year to date now for this quarter. It was up just a little bit, but I think it ticked downward a little bit with rates crept up a little bit here. But rates are pretty flat across the board. I think I was talking right before the meeting, I think you get 4% in a money market, maybe 4.2%, 4.2% on a 2-year, 4.3 on a 5, 4.5 on a 10. It's pretty flat. Everywhere is in between 4 and 4.5 pretty much for the Treasury curve. But again, your bond managers can buy investment grade stuff, and now they can go into corporate investment grade bonds and still buy in the 5% range or more. So that's good news longer term. We don't have to take as much risk in the portfolio if we can own more bonds paying 5%. Back in the last few years, bonds were paying 1% and 2%, but we still had a goal of over 7% that we wanted to make in the plan. So we had to increase our equity allocation, increase our other asset classes in the portfolio in order to try and continue to make that. You couldn't just do 60% stocks, 40% bonds and expect to get 8% or 7%. Wasn't going to happen. But now we're kind of getting closer to where we can raise that fixed income. We have a little bit over the last few meetings. You're up a little bit more in bonds, and we're about 30%, a little over 30% bonds and money market right now. So I'm comfortable with that allocation. So if you go to, why don't we just skip on over to page 7. Again, Hannah, Blake mentioned that they manage about 60%, I believe it is, about this 60% of this portfolio. This goes way, way, way back they used to manage it all when they were Sunbank Capital Management, I think it was. And anyway, it's been an evolution. It's a little unusual to have it this way, but I've got another plan with Blake that works the exact same way down in South Florida. So he has discretion on about 60% of the portfolio, he and his group, and then we help you with anything outside of that they don't do, or, it's asset classes they don't manage, and we've helped you diversify the portfolio more. We're still responsible for monitoring the entire portfolio, including the money that they manage, and if there's something in there I don't like or don't think, I will call Blake and say, what are you guys thinking? Just like I asked him about the growth versus value tilt to the portfolio now, and we have a lot of those discussions. So he's made changes in the portfolio in the past, but that's kind of the overall picture, and that's how, our job is still to look at the whole thing. He actually manages, he and his team manage a large portion of it, a little over half of it. That's your asset allocation. I will say on this chart, it's a little misleading. Those first three categories, you see like a big underweighting in growth and value, and then a big, in core, we have zero. Just treat those three together as large cap stocks. And when you add it up, we're pretty close to the target in the large cap stocks, okay? So that's again, kind of a misleading way we do this chart. I think I may recommend we change it. But it does give you an idea. The gold bar is the target from the investment policy, and the blue line is the actual allocation as of the end of that quarter. Go over to performance. Why don't we just skip over to page 10. So for the quarter, it was a wild quarter. You wouldn't know that by this number, minus 0.9, pretty flat. But if you remember, after the election, we got a big bump in the market. The market was all excited about the results because it was going to be a very pro-growth, deregulatory kind of environment, very pro-business environment, and the market just took off. And then, I don't know if you want to say reality set in or whatever, but the market sold back off a little bit then, and December then was not a good month. It all rotated right back to those Mag 7 stocks in the last part of the quarter, and everything else got hit pretty good. So ended up being a negative quarter, but you also had bonds down 3%. Growth, you can see this, and this growth portfolio was up 9 for the quarter. Value was -2 for the quarter, or -5 for the quarter. So that shows you how the market rotated during that quarter again, with those Mag 7 stocks being in that growth benchmark. Everything else was flat to kind of negative, and then bonds were down 3%, or 2.6%. So kind of a tough quarter, but on a one-year basis, the calendar year 24, up 10.1%, in line there with the target or the model, which was up 10%, despite the fact that the value portion underperformed by 9%, but it's not a large portion of your portfolio. So those allocations have really helped you in terms of how they structured that large cap portion of your portfolio. What else did I want to mention? Oh, remember, this is a calendar year, 1 year. Your fiscal year ends 9/30. You just came off of a 21% plus fiscal year. So we had a great fiscal year, but so far kind of a rocky start to the 2025 fiscal year. Going into today, I was going to be able to tell you were probably up 2 or 3% going into today. And I think it's given about 1% away today. So you're probably still in positive territory for the fiscal year to date as we sit here today, but things got a little blown up today. And then your 5-year number, 7.1 versus 6.8. I think we have a 7.25. We still at 7.25, 7.25 assumption rate here. So I like the allocation, and we should be able to hit that target without any problem longer term. All the different funds are listed on page 12 and 13. So you can see the returns, both gross and net of fees, for all of the individual holdings in the portfolio. I'm not recommending any changes today or any rebalancing for that matter. We're getting a little rebalancing today, whether we like it or not. In terms of equities getting knocked off, a couple percent or a percent or so today. So the page 14 is just a chart that we don't always cover, but I'll mention it. This is going back to the fourth quarter of 2019. The blue line represents the market value of your portfolio as of the end of each quarter. The green line is the cash flow. So you can see by the green line sloping down, there's more money going out than coming in to this plan, showing a very mature plan. Also shows that we need some earnings to keep things going the right direction, right? So the blue line is the market value, shows the bad effects of 2022, but shows we're inching back up to almost getting closer to those valuations where we were up in 2021. So we closed the year a little bit over 34 million. So climbing back up again. There's several analytical charts. I don't usually go over those with you, but page 16, maybe I'll end on that one. And if you have any questions or any charts you want to go into in detail, let me know. But page 16 are your fiscal year returns dating back to 2006. And you can see some major volatility starting there in 2021. But our goal is 7.25. I actually went ahead and did the math on those 19 full years on this chart, and I came up with about a 7.4% average, despite a minus 18% year in 2022. So that tells me that the long-term target is probably good. I mean, it's right where it'll get us to where we need to be. That doesn't mean we can escape volatility when it hits like it did in 22. As we learned, we can't. But I think you've got a well-diversified portfolio. I will tell you this, if the market goes back to Mag 7 or the Fantastic 5, whatever it is now, if it stays that concentrated, we will struggle to keep up with the benchmarks. If it broadens out like I kind of expect it to, we should do very well. But it can't. Those 5 stocks that are left in the Mag 7, to me, are just priced to absolute perfection. So anything that, when we saw DeepSeek come out, they took a huge hit one day. Now they've come back. I think most of them are back to where they were prior to DeepSeek. But for a couple of days there, it got really rocky there. And then they're getting hit again a little bit today. So I don't like to expose portfolios to that kind of risk. And so we'll stay diversified and really kind of hope the market broadens out and rewards you. But I say we broaden out and conservative, but you just came off a 21% year, so we had enough in there to make some money. So we should be in pretty good shape. Just a quick conversation with Doug there before we started the meeting, and I think your funded ratios and all that are pretty healthy. So I'm not recommending any changes to the program. I think everything's going in the right direction.
Wonderful. Thank you, Mr. Cole.
Any questions?
Yeah, so you say it's going down here, which it is. I see it's ticking up. So what do you think the realistic rate of return should be?
Real estate?
The rate of return should be
Oh, the real rate of return?
to keep it
Again, I
where
think-
it needs to be.
I think, you mean for the overall portfolio?
Yeah.
I think, the program is designed that, and we've got, we have to submit a report every quarter to the state. I don't even know if you guys see it, but it shows each asset class and what we expect the return to be and what that gets us in the total return. It's all projection, it's all crystal balling, but it's based on historical data too and all that. So it's designed to give us the 7.25 plus. So I think you got a good chance of making 8% plus with the way this portfolio is allocated, and that's what I would expect. I don't see any reason why we won't be there on September 30. I'm certainly not going to predict another 20% year, but I do think the bull market can continue. We're only 28 months or something, I forget the exact number, but 28 months into the bull market. The average bull market runs closer to 60 months. So there's plenty of room for it. And if you really dig into the markets, the markets look very expensive across the board because of those 7 stocks and their valuations. You take those out of there, the market's still a little expensive relative to historical, but nowhere near out of line like it was before. So I think there's some room to run. Earnings have been coming in at, I think they were saying so far this year, the reported earnings, most companies were up about 17% year over year, so that's strong. And so if you believe in price earnings multiples, then that means prices should go up too to maintain those multiples. So barring any crazy actions from the Fed, again, the tariffs concern me, but just in the short run. You see a lot of different reactions to the tariffs. He might place a 10% tariff over here, but then their government, I think China's subsidizing a lot of that tariff, so you're not really seeing prices increasing because of it. Or you'll see, I forget who it was in Europe, might have been Germany, but I can't remember. We threatened to slap a tariff on cars, maybe, I think it was cars, but their 10% tariff on us went down to 2.5 or 2.25, just like that. So, yeah, there's a tariff on one end that went up, but then that one went way down. So it's kind of a debate. I think short run, it's got to be inflationary, but longer term, I don't think it necessarily has to be. Especially if we start making a lot more goods in the U.S. to avoid the tariffs. In the long run, that should be good. But I guess the short answer to your question is I expect us to make the assumption right. Don't have any reason at this point to believe we won't, but who knows what will happen between now and September 30.
Thank you.
Does the board have any other questions for Mr. Cole? Seeing that there's no other questions, lastly, we have Doug Lozen from Foster & Foster with the actuarial valuation report.
All right. Thank you, Hannah. I'm going to come around and just fire the iPad back up with password. Thank you. There we go.
Thank you. That's good.
All right. Good to see everybody again. I promised to keep it short and sweet. It's pretty much the same answer I had when I was here last year. I start on page 6, which shows a change in the city's contribution rate. As a reminder, as the actuary, our role is to adjust the city-required contribution each year based on experience, either up or down, in order to keep contributions flowing in that get invested, ideally growing at 7.25%. So as benefits come due in the future, there's sufficient funds in the trust fund to pay those out, and along the way, keep the funded status at a reasonably high level. Understanding that from year to year, you're going to have relatively minor changes in the contribution requirements and the funded status. So this is really just a true-up every year that we do. And every 5 years, we go through an overall review of all the assumptions to see if we need to make wholesale changes on a go-forward. We're not there yet. Next year is when we'll go through that exercise again. So here, what we're doing for the in between those 2 5-year studies is we make these small adjustments, leaving the assumptions alone. So we are still assuming that investments are growing at 7.25. We're still assuming that individual members in the plan are getting salary increases between 4.5% and 5% a year. We still have assumptions for turnover, what the likelihood of members leaving the plan before retirement eligibility. We also have assumptions for when members retire, knowing age in service, according to the ordinance, provides the eligibility, but are the members doing it right then, or are they deferring retirement? All of these assumptions we leave in place for 5 years and simply adjust the contributions and the funded status accordingly. Again, being a general employee's pension plan, it's relatively stable compared to, say, a police and fire pension plan, which has earlier retirement dates. There's a lot of stability with this plan. In spite of that, there's still moving parts. So if you look at the page I opened up to start, this is the summary of the summary report. The city's required contribution for the current fiscal year is the right-hand column. It's 11.59% of payroll. That, I say it's for the current year. That was the valuation date done as of October 1st, 2023. We project 1 year forward so the city has time to budget, because I'm usually here at the February meeting announcing the results, and the city wouldn't want to get the results that late in the year. They would have to adjust their contributions this year. So when I did the 23 valuation and was here a year ago presenting it, it's for this fiscal year. So it's the same exact 11.59% that I reported last year. Now for budgeting, the city should use that 12.1% for fiscal 25-26. And the primary reason for the increase is this is the third year in a row that the city has increased salaries a lot compared, it's a relative term. I say a lot compared to the assumption. Again, the assumption I mentioned just a little bit ago was in that 4.5% to 5% range, which we used based on the last experience study we did. We did that 4 years ago, and we had looked at the 10-year average coming up to that and said, okay, 4.5 to 5 is what was happening. Well, with inflation, everybody in the state, all the local governments in Florida are doing what they can to retain employees and recruit new hires. And part of doing that in an inflationary environment is to increase salaries. So back of the envelope math, if I take an average employee in the plan that was here 3 years ago, their salary on average is about 50% higher than it was 3 years ago. Based on the assumption, the 4.5 or 5%, we would have expected the average salary over that 3-year period to increase about 18% or so. So that has a lot to do with why you see an increase as a percent of payroll is every year that the city gives out an average salary increase above that 4.5 or 5%, we are now projecting benefits to retirement that were higher than the year before, higher than we had expected. And on a present value basis, as the actuary, we come back a year later and say, okay, you need to make a slight adjustment to the annual contribution requirement because we expect benefits are now going to be higher by X. Yes, sir.
I don't want all the details, but wouldn't higher pay equal higher contribution also?
From the members?
Yeah.
Correct. However, the members are only putting in 5% of their pay. I say only, I mean that in comparison.
Sure.
If you look on page 6 here, the minimum required is 16.59% for this year and 17.1% for the next year. That's the true actuarial cost that we see necessary to keep the plan actuarially sound. The members are contributing 5%, so the difference comes back to the city. So yes, the members are putting in more, that's true, but then the city's also putting in its own proportional increase. Now, while this is an increase, I explained because of salaries, it would have been higher had you not had favorable investment performance over the last couple of years. And the good news there is that your investment performance was we're using a 4-year average. And I say good news because we want to minimize volatility. Your return for this last year was over 20%. But we average that over 4 years. So that means rather than giving you a report which immediately recognizes that full 20% return, we're recognizing a quarter of it. And we'll do that for the next 4 years. So what I'm hoping is that while I think the city's requirement may still go up a little bit as a percent of payroll, maybe for 1 more year, those prior positive returns total over the last 4 years will begin taking over and should stabilize out the city's requirement. Now, I put a caveat to that because no crystal ball. I have no idea what the city might be doing as far as additional salary increases over the next couple of years. And there's a trigger to that as well. There's these little tentacles that go out. As actuaries, we have to factor in. If the city is still increasing salaries, that means they're trying to reduce turnover. I've seen there's been a lot of turnover at the city. There's been a lot of folks coming, staying for a couple of years and leaving. That's positive for a pension plan. That means the members are putting in their own 6.5. The city's putting in 10, 11, 12. If the member leaves, they take their 6.5 with them. What the city put in stays with the pension plan, but the liability is gone when that person leaves. So high turnover equals good for pension plan, but it drives the city crazy. So if the city's increasing salaries to try and keep people from leaving as much, then favorable turnover experience in the next couple of years might start tapering off. So this is a long way of saying this is why you have to see the actuary every year is we do these true ups based on what's happened in the last year compared to what we assumed happened. I every year do a presentation and I try to get everybody kind of warmed up to the idea of, what might be coming the next year or two on an actuarial basis. And the best I can do, aside from the details I just gave you, is that I still think stability. I think the city's requirement will go up for another year or two slightly as a percent of payroll and then stable off. So before I get you an update on the funded status, can I answer any questions from what I've covered so far?
Is there, I probably shouldn't open a can of worms, but.
Go ahead and
is there-
open.
The city's portion, is there usually a trigger where a municipality starts saying that's too
Oh,
high?
that's
Okay.
subjective.
Yeah.
I will tell you, back 10, 15 years ago, the city's requirement was higher than this as a percent of payroll.
Okay.
And it came quite a bit down, and then we changed certain assumptions. We lowered the investment assumption, which was prudent. We did that in stages. A lot of things have changed in the last 10 or 15 years, especially economically on the Space Coast. So that's about as far as I'm going to go. I know because we do other plans too. We do the Cocos, the Melbournes, Titusville. I know this area is a lot better off economically than it was 15 years ago. So I don't know what the trigger of pain is nowadays for the benefits package.
There's no answer to that.
Yeah. Although I do know, I can answer probably 100% accurate that if the contribution requirements go down, everybody would be happy. Okay, so let me get you an update on the funded status. If you just touch the iPad and keep moving to the right, just swiping page 17, or you can just keep going until you come across a graph with green bars. This is a 10-year rolling history of the plan's funded status. And it was very stable in the 90s, even cracking 100 until about 2021, and then it's been gradually tapering off. That tapering off has mostly to do with the salary increases, the 3 consecutive years of double-digit increases. But I'm not concerned. This is one of the reasons we put this graph in here is there's no big change from one year to the next. Everything is very gradual. We're funding the pension plan for many decades. Any given year, you're not going to expect a big change in the city's requirement or in the funded status. I think if I was to guess, it might get a tad bit lower, stabilize out, and then begin going back up again, just from everything that we've talked about today. But I'm comfortable with your plan. I'm comfortable with the assumptions. I think it's well-funded. Your investment performance is on par with all of the other plans I see around the state. This last fiscal year, the 20-plus return is very good. Surprisingly, that's about average. I've seen returns this last fiscal year doing valuation reports ranging from 16 to 30. And the ones in the high 20s are, those are in the top few percentile. Your return, the 20 to 21, is actually about average, maybe a little bit above average. And your 4-year average is right in the wheelhouse of what I've seen. So you're doing perfectly fine performance-wise on investments. We'll just have to let future experience dictate where the requirement goes going forward. So I'm going to call my report done. I'm happy to answer questions. Once they've all been answered, then you'll need to approve this. And then we have one exercise after that.
Does the board have any questions at this time?
I have one random question. In your experience, how would a drop program affect our plan? if we brought in a drop
Generally neutral. Most actuaries, including our firm, say if a drop is set up in the standard way a drop program is, it's cost neutral. That would be, you have to be eligible for normal retirement. If you have a fixed interest option, it should be below the 7.25%. I'd say probably in the 3 or 4% range, or just whatever the plan gets. And you should limit the participation period to no more than 8 years. If those features are built in, then we would say long-term, there's no real impact on liabilities.
Okay, thank you.
Any other questions?
So we'll need to take a vote to approve this, and then I have one other thing for you all to vote on.
Approving it, to accept it?
Is it text?
Yeah, you could say, motion to accept the October 1st, 2024 evaluation report.
Motion to accept the valuation report presented by Doug Loza.
I'll second.
All in favor, say aye.
Aye.
Okay, thank you.
Okay, there's that, and then there's
Yeah, the next item on the agenda, if you want to remain at the podium, is
guessing.
under informational items, we have the Foster and Foster Social Security government pension provisions.
Before we jump to that, which that's a very quick answer on my part, there's something we have to go through every year now that you've approved the valuation report. It's for the state. It's called the Declaration of Returns. I've said it so many times, I'll say it and you can say so moved because no one remembers it. It's simply the Division of Retirement wanting the pension board to acknowledge your expectation for investment return for the next year and the long term. The exact language is, for the next year, the next several years, and the long term thereafter, you expect a 7.25% net of fees investment return. That's the actual motion that you can just say so moved, and then you have to vote on it.
Where does that 7 come from?
We always recommend that you pick the assumption that you just approved in the valuation report for this purpose.
Okay.
Say 7 or
7.25.
Do we need a motion?
Yes, and you can say so moved to the language I just gave, and then you'll have to vote on it.
So moved.
I'll second.
All those in favor, say aye.
Aye.
And I'm guessing Pam probably has, it's just, you take out the same letter that's gone to the state for the last 20 years and resubmit it. Yeah, no, it's somewhere, it's,
Can you send a copy of it?
yes, well, you know, we don't serve that role. It's somebody acting as the administrator for the pension plan has had to send this to the state for the last. But now that Larry's coming, he might. Hey, Larry, sorry, we're invoking your name since you walked off. Do you facilitate that Declaration of Returns letter? They just voted on it, they put the 7.25 in, but we're trying to figure out who sends the letter to the state.
We do a draft, I think, and send it to you.
Well, there you go.
Great. Thank you.
Perfect.
We'll get one for Pam.
Okay, I facilitated it, so we're good.
Oh, wait, the declaration letter, what we do is the letter, we'll get with you, we'll figure it out.
I put in a 9.25, is that okay?
How, what'd you say?
9.25?
As long as Blake signs off on that
Okay.
guarantee, I'm good with
There we
it.
go. Just, that's in the minutes.
He's got 60% of the assets, he's the one that's gotta give you the.
Okay, so Hannah, the last part, the Social Security memo, that's informational only. It's from our legal department at Foster and Foster sent out this memo. It's this new law that passed right at the end of the Biden administration. Those municipalities that didn't contribute to Social Security, there's a bit of a windfall for those who are getting Social Security and a defined benefit. I'm guessing people working at City of Cocoa Beach have always contributed to Social Security. Yeah, so this is informational only, just as a law that passed. It doesn't pertain to Cocoa Beach because of that. So there's no action needed. I just gave kind of the back of the envelope of what it is.
Thank you. Does the board have any questions at this time? Seeing that there's no questions, the next quarterly meeting.
Well, I have one item I'd like to mention. I'm not sure about this, but like we voted on a retiree. You know, I'm not, you know, we don't even know who it is or what it is, or like we're voting on something we don't even know about. I don't really know if that's normal or,
I believe within the settings of the board, we can't disclose the name of the retiree since it's public record.
that's fine, but what are we voting on? What if it's
Just approval of the retiree?
the retiree?
Yes.
It just seems bizarre to me. I'm not being critical. You know, it's like voting on something that you have no skin in the game, you know? We used to get the people's names and stuff, I'm not saying we should.
They don't allow us to
I
get
thought
names anymore.
What's that?
They don't allow us to get.
That's fine. It just seems like, why are we voting on it
Just
then?
how many, so the board knows how many retirees have happened in the quarter.
I see. Because we've had those mistakes of overpayments and stuff, and, you know, not that we're gonna verify that, but.
Are there any other questions?
No.
Okay. The next quarterly meeting set for May 15th at 3 p.m. And being that there's no other business that comes before the board, I'd like to have a motion and a second to adjourn.
I make a motion that we adjourn the meeting.
Let's not second it.
All those in favor say aye.
Aye.